policy, reg, and legal frameworks for stablecoins are really going to be what sets the stage and is the foundation for how they can grow and scale in the future. And so I'm delighted to be joined by a panel of experts, but also some of my very wonderful industry friends and colleagues. And I'll give them a chance to introduce themselves. Varun, everybody already knows you, but you're back again.
I won't say any more. You've had plenty already from me.
Tom.
Hi everyone, I'm Tom Rhodes, the Chief Legal Officer at Agant, which is one of the sponsors and an aspiring GBP stablecoin issuer, one of not many, and before that, financial regulatory lawyer.
We love a lawyer, and as evidence, Diego.
Thanks. Yeah, so my name is Diego Ballon. I'm a partner here at Clifford and do lots of fintech work.
Michelle.
I'm Michelle O'Connor. I run global expansion at Taxbit, and we're a global financial compliance platform.
Great to have all of you. So what we're going to do for the panel today is first we're going to do a quick fire round where we just set the scene on what's happening across all of the different jurisdictions. Then we're going to do a bit more of a deep dive, talk about what really matters when it comes to regulating stablecoins and a bit more of the intricacies there. And then we'll do a bit of a future-focused look in terms of what might be coming down the pipeline for stablecoin regulation. And so just to kind of kick us off, Tom, obviously, as we're here in the UK today and you're an aspiring issuer, where are we at when it comes to the UK for stablecoin regulation?
So,
very quick, because we'll deep dive it later.
Yeah, you know me. All right. At the moment where we are is we've got a roadmap from the FCA, which basically tells us that in should be 2026, possibly 2027, we'll have a comprehensive regulatory regime for crypto assets, which is not just stablecoins, but trading and other activities. And the latest update, I suppose, is that we've had Treasury publish the legislation that gives the regulators that power, or at least they published a draft, and the FCA has published proposals for stablecoin issuance and also for prudential regulation, so capital requirements, that type of thing for a stablecoin issuer.
It's going to be a very busy summer in terms of UK consultations. Michelle, can I come to you next? What's happening in the US?
Sure. So it's stablecoin summer for sure, I think globally. In the US, what's interesting is we have states. So at the state level, states are exploring if they issue their own stablecoin. That becomes challenging because you go cross-border, then how do they work together? Who goes first? Is it first mover? I live in California. California is actively having conversations about that. You've seen Wyoming has really led the charge. You have Texas that's moving toward a reserve model versus issuing a stable coin. We just had the Genius Act pass, which has made quite a bit of progress with the new administration coming in. It's definitely flipped the script on how digital assets in general can operate in the US. And with the Genius Act, I think there's a lot of clarity. There are still some nuances that were left out of that I think some of industry would have preferred inclusion for clarity, but overall a lot of forward movement.
And still some exciting discussions to come with Genius
Yes.
going to the House as well, so we can get into that later.
Always fun.
Yes, but come to Diego next. What about the EU, which is actually, operational compared to a lot of the discussions about regulation in other regimes?
Yeah, so EU is super interesting in the sense that they've launched, MiCA is there, people have now been approved, so there are USDCs famously already operating. The teething problems are coming out, I think. So we've just got clarity or a statement around the overlap between the crypto asset activity and the payment services activity, and how where the licensing position lies when you're moving around stable coins as more than just an issuer. So that's happening and the debate's going on. But there's also been the non-paper by the Commission around multi-issuance coins and what happens when you've got multiple jurisdictions which impose rules. That debate, I think, is just commencing. And there is, I think, some fear that when you've got a coin that's issued by multiple issuers, they may not be regarded as fungible technically between them because you've got different requirements. And so I think that we'll see, and it's going to be a public entertaining spat there. So we'll see what happens. But so teething problems coming, for sure.
And I think we'll definitely get into that when we talk about reserves in a second as well, because this multi-currency issue and multi-issuer point is coming up in a lot of consultations, including the one that's out in the UK at the moment.
Yeah.
But before we get to that, Varun, APAC, what's happening over there?
Just very quickly, it's obviously a very broad region, many different regimes out there. And it has, for the past few years, been very progressive. We've seen the likes of the MAS pushing the use of digital assets and Project Guardian and all that kind of thing, bringing actually many of the banks to the table. I think one of the most interesting things that we've seen most recently is Hong Kong. The HKMA has put out a stablecoin regime and made that, published that. But also was in Australia earlier this year, and it's clear that with 1 in 4 voters caring quite a lot about crypto, that they're having to push further as well. And so we're expecting to see more concrete guidance from countries like Australia as well, following everything that's happened in the US this year.
Yeah, no, it's certainly, I think, really exciting developments. And as you can see there are 5 of us, so I'm taking moderator's privileges to also talk about the Middle East, even though I'm technically moderating, not on this panel, just to highlight that obviously a lot of movement coming out of the UAE when it comes to stablecoins as well, specifically Abu Dhabi. So FSRA, ADGM, they are the ones who are regulating stablecoins predominantly in the UAE, and theirs is the Fiat Reference Token, or FRT regime. Though they did note when they put this out that it was heavily influenced by what they looked at from MiCA as well as New York DFS, which again, those were some of the set regimes at the moment when they were building this out. So again, some were really comprehensive, and indeed, I think we've seen a lot of stablecoin issuers, especially around Abu Dhabi Finance Week last year. We saw a number of important announcements from the likes of Paxos and Circle, for example, about their plans to continue expanding in the UAE. So definitely important to note that as well. But now let's get into, I think, one is probably the most discussed point when it comes to stablecoin regulation, which is reserves and backing assets. And it's something that is not totally consistent across all regimes, especially considering what we're seeing, in the UK at the moment, potentially taking a bit of a divergent approach. But perhaps maybe, Diego, I could start with you. What do you think are some of the most fundamentals when it comes to reserves and backing assets? What are regulators worried about? And what is the aim usually with the regulation that they put in place for them?
Sure. I think fundamentally, certainly under the MiCA framework, and I think you can see traces of that in the UK, the idea here is that there should be sufficient backing assets to actually pay out every token holder when they come to redeem. That, to me, is a slightly flawed way of thinking about it, because it assumes that people will actually go back to the issuer and redeem. But that's the risk position that regulators are taking, right? They're saying, well, you've got an issuer that's not regulated as a bank. We don't know how they're going to operate, so we're going to slap on a bunch of capital requirements. They're technically meant to cover operational risks, but actually the capital requirements are pretty high. And on top, you've got your requirements on the reserve assets, which basically mean that you need to manage your reserves and hold them secure, and then you've got trust arrangements that sit on top of them. So it seems like there is this assumption, which, in all fairness, regulators are meant to be worrying about these risks, right? But there's an assumption that the issuer needs to be good for every coin issued at all times, and that seems to me to be slightly different to what you would expect from any other sort of payment provider or bank in this space. I think as this progresses, I don't think that there's going to be necessarily much flexibility on that. So the question will be, how do you get the right composition, and are we doing that correctly? And are we applying the right rationale when we're applying capital requirements? So can we tinker with this in the medium term so that actually it's not a huge barrier to entry, because you have to hold, I don't know, hundreds of thousands of pounds in capital just to be able to operate, and then you need to hold the reserve assets. So the barrier to entry is just so high that makes it really difficult. And Tom has probably ideas on that.
Well, yeah, and I just want to clarify one thing too, which is really important here, which is that no one is saying that stablecoins should not be one-to-one backed. That is quite literally the whole point. But instead, it is this conversation from a maybe philosophical point of view around conversion versus redemption. And do you need to be able to redeem everything all at once? And Tom, I know you must have thoughts about this.
I mean, that's the issue, is how do stablecoins actually work, and then it comes back to conversion, which is a secondary market sort of action where a holder will go and exchange their stablecoin for money with somebody other than the issuer, or does the issuer need to be involved in that, and does each holder need to have that access to the issuer to give back their stablecoin and get bank money, for example, back in exchange? And one of the challenges we're having with the regulation is that no stablecoins work like that. So at the moment, so none of the big successful stablecoins, which have proved their kind of stability through all kinds of crypto crises, none of them offer redemption. So the ability to take your stablecoin and give it back to the issuer, to every single holder. In reality, what they require is that you become an onboarded customer, and they set conditions for eligibility and then even for redemption. So, for example, you know, with Tether, which is the biggest one, to redeem your USDT, you have to be an onboarded Tether customer, and you have to redeem in a minimum value of 100,000 USDT, which clearly makes it not accessible to everybody. And they have published stats, which I always like to quote, which are that they estimate that they've got, I mean, they issue in the sort of hundreds of billions of USDT, and they estimate that they've got hundreds of millions of separate sort of individual users, and they only have, from publications earlier this year, fewer than 1,000 onboarded customers through which all of the USDT is distributed and converted in the market. So if Tether or Circle or an aspiring GBP stablecoin issuer had, issued at large scale but had to be able to redeem for every single holder, that's a huge operational burden. They're not like banks, and that you're talking millions and millions of potential KYC processes, onboardings, setting up the bank payments, and it's not necessarily a proportionate way of operating. It's not necessarily the business model, but it is something that actually the regulators are imposing rather than what sort of emerged as the actual business model.
Yeah, no, it's a really interesting point, and I mean, I'm sure Varun, you probably have thoughts on this as well, because I think it does come back to the point of what are the risks that we're trying to mitigate here, right? And then does the regulatory requirements that are being imposed for reserves and backing assets actually mitigate those risks? I mean, what do you think?
Yeah, so I totally get it from the regulator's point of view. As a former financial stability regulator, I understand that you need to eliminate this risk that the system could fall apart and suddenly the value of this could drop and suddenly there's a run on a stable coin and people need to be able to get their money. But the principle exists in a world in which you had to come out of the stablecoin ecosystem back into fiat. That's the assumption. I need to redeem, get out, because crypto has collapsed. Stablecoins have collapsed. I need to get back to something I trust. But the Tether model you just described is fine, because as long as I can exchange it for USDC, I don't care. As long as I can exchange it for another currency or Bitcoin, I don't care. And so the point is there is much more choice in this ecosystem. And so I think the model is slightly, it needs to develop further, and the risk you're trying to protect can be managed, even if you have different maturities of assets, different gating processes. We've seen that in other parts of the financial system in the past, whether the model is a gating in a money market fund for some portion of the assets, whether it is you need to have some cash at hand because for that emergency situation. But we have seen, if you've got really good liquidity management, even those big issuers, when they have had stress redemptions, they've been able to cope. But that doesn't mean everything has to be held in a bank account, in escrow, at 60% of the backing assets, just for that emergency situation, because that's extreme.
Right, and I think that while this comes back to the point of we want to be prepared for emergency situations, of course, that's very important. Operational resilience is a fundamental part of being able to operate in a regulated financial services system. But we do need to distinguish between what is BAU and then what is a stress scenario, and then have risk metrics for those accordingly, rather than having one risk metric for everything that assumes a stress scenario at all times. But I think that there are, some important ways that this can be mitigated, of course, and it comes back to transparency and disclosures. And so, Michelle, I'd like to come to you to maybe get your thoughts on this, because obviously you guys sit a lot in the information reporting space, and I know you feel very strongly about it. How can transparency and disclosures around stablecoins help to, one, mitigate some of these risks that regulators are worried about, but also to inform consumers so that they know what the BAU scenario is?
Before I answer that, I think one of the challenges that we're seeing is with wonderful intention to regulate and ensure safety for consumers, which is the goal, global regulatory, I think they all share. It's trying to regulate based on the way a traditional financial model works. And they're creating a situation where, okay, we're going to protect, and this is what it looks like, one-to-one, et cetera. However, the ecosystems exist outside of that framework. So what they're trying to mitigate through their modeling and their requirements actually doesn't address the challenge or run-on scenario that I think they're all trying to avoid. So it's very like alpha and beta scenario where they're not actually reducing the risk, they're just creating a way to work around it. What we see and what we address quite often at Taxbit and then in the industry in general is most things are on chain. So there is transparency. There is a way to run. We work with some clients who have 24/7 reporting. So at any time people can run rate and see that they're reserved, that they have backing, that where they're at. And regulators, auditors, et cetera, use that as the checks and balances to see how things are operating, have comfort level. There are options in place, including what we offer, to make regulators more comfortable, but I think there's this understanding of decoupling stablecoins from crypto a little bit more to help them understand the use cases that we're talking about today are maturing the way financial systems work, and they're not necessarily how crypto works. And decoupling that a little bit more will help, I think, regulators feel safer in a situation where there is a way to have transparency. You can have reporting. And what we're trying to avoid in financial collapses, as we saw a few years ago, the ones who were doing it right survived and thrived. And that wasn't a reporting scenario, it was a run on the banks.
Very true, very true. And
if I may come in, yeah, so I mean, playing devil's advocate here, I suppose a regulator would tell you, well, you know, everybody thought Lehman Brothers was safe until it wasn't, right? So that's the classic answer that they give you. It's you know, there is, yes, of course, everything is rosy in the day-to-day, and we can disclose and we can be transparent, but actually, when the crisis hits, then nothing works, and so you need to be able to answer that. But I think that is not dissimilar, and I think if we start thinking about stablecoins in a slightly different way, if you know, this is not dissimilar to what the banking system has to deal with today, and there are methods of managing that. You've got guarantee schemes. You can create. I think that is the next step, is to try and think about stablecoins more like an asset which should be capable of being managed from a risk perspective with guarantees and things like that, which would actually then take away some of those dangers. Because if you had the same guarantee scheme that you've got for deposits, it sort of looks like very similar to the exposure that a retail client would have on their bank account today.
Well, Tom is giving me a look about this now. So I would note that, you know, important to note the distinction between deposits and stablecoins. The stablecoins are bearer instruments, not deposits. So there isn't credit creation. So would that be exactly the right risk metric? I don't know. But I want to let Tom maybe come back on that, because I feel like you had thoughts.
So no, I completely agree with Diego. And one of the other areas that people talk about is the Bank of England playing a similar role to what it plays with banks by providing liquidity or a lender of last resort for that, you know, stressed redemption if the stablecoin issuer faces a huge amount of redemptions and has to liquidate its high quality assets, but it can't do it quickly enough. And that, again, is the kind of thing that, if that's what you're concerned about on a systemic scale, for example, is compatible with the stablecoin model without trying to sort of engineer a different product. And so, you know, basically one of the challenges we have is trying to get regulators comfortable with working with the stablecoin model and accepting that there may be some stress scenarios, there may be some risk scenarios, but that you need to have proportionate regulation, not regulation that eliminates all risk, which is where we are with banking as well. I mean, we still have bank failures. We had them last year. So, yeah, I mean, they accept some level of risk, and it's about proportionality.
Do you agree?
For me, the clear thing to just draw out here, the distinction to draw, is credit risk versus liquidity risk. And you've touched on it there. I think it's really powerful, actually, in the Bank of England's revised proposals, thinking about potentially doing things like liquidity operations for those assets. I think that is what they want to address. Now, you don't open up a discount window facility and a credit facility like you would for a bank. A bank is different and a deposit is different. But for a stablecoin that's issuing payments and you want to manage that liquidity risk, you put those liquidity safeguards for that emergency situation in place. And actually that allows you to have a slightly different position in terms of managing those backing assets, because you have that emergency situation covered in a different way. And it's really important that regulators are much more specific about the risk they're trying to manage and how you use the tools that they have. And there are many tools to manage those risks.
Do you agree, Diego? Do you think we've got there?
Yes, I think we do. One thing I would say, and I think this is sort of now established with regulators, we won't get away from this, is legally a stablecoin represents a debt on the issuer, and a deposit represents a debt on the bank. That's just the way regulators think about this, and the way the rules are written. And as a result, you're sort of managing that credit risk for the retail person. And so I think that's where they're coming from. I think what hasn't come with that thinking is, yes, but we're not extending FSCS protection. We're not extending sort of these other things that retail deposits get the benefit from. And I think that's a policy decision. It's a policy decision because, for whatever reason, I don't want to guess, there is less willingness to make the stablecoin an asset that should be adopted. So they're removing incentives for adoption, and why we can debate, but I think that's what's happening.
It's a very interesting question, especially in the context of the UK. So I want to come back to this point about how do regulators actually drive stablecoin growth in the future problems. But before we get to that, I want to come back to one other kind of thorny question when it comes to regulation, which is on this multi-currency model. Mentioned it in the beginning, multi-issuance. Perhaps we can come to Michelle first, if you have any thoughts on that. What the US is thinking about this in terms of reciprocity. Most stablecoins are dollar-backed at the moment. Are you hearing anything when it comes to multi-currency?
If you ask the US, no, it's US or nothing. I mean,
true,
right? But the reality is, where we've seen highest level of adoption is use, while it is associated with dollar USDT, the velocity and scale and where it's actually used in volume is outside of the US. So arguably, looking at alternatives to or secondaries is naturally where it would go, especially when there's uncertainty in specific markets or where governments are going, and if there's large tariffs that get issued or other things that happen where the politics start playing into the financial market is where I think it's really interesting. And I think if you go back to the ethos of what they're trying to solve, it should not just be tied to one currency, because then it's mitigating some of the use and democratization of kind of what the ethos of what these were created for. So I'm seeing a lot of encouraging new projects come out, and quite a few in Latin America that are very interesting to bring the ecosystem forward, and I think probably also work around some of the regulation issues that my fellow panelists have said, creating challenges.
Good points, I think, and I agree. I think there's a lot of really interesting developments in South America at the moment, and I think if we had this conference again next year, that will have to be itself. But Tom, I want to ask you maybe how you guys are thinking about this, because obviously you're aspiring GBP issuer, but how are you thinking about multi-currency, let's say, Agant in 20 years time?
So yeah, we're focusing obviously on GBP at the moment, and seeing a lot of interest. It's all about, there's different sort of markets. There's existing crypto activity, which is mostly done in USD. There's some interest there. The bigger area of interest for us is payment services firms who are providing services to people who use GBP, and then asset managers, investment services in the city where they're looking to bring business on chain. And the UK, a huge sort of global financial centre, but slightly behind some other areas, some other jurisdictions in terms of on-chain financial services. But one of the sort of jurisdictional points that we're grappling with is whether you even want to issue from the UK. So you could issue a GBP stablecoin from somewhere else, and there already are GBP stablecoins. I mean, it's frustrating to hear how many. It's every week I'm hearing about a new GBP stablecoin being issued from the Virgin Islands or somewhere else, and so it seems like that's to some extent one of the considerations, because you don't need to be plugged into the domestic payment systems. You don't need to have a local sort of bank account. You just get a wallet, and that's the whole point. So it's so much more accessible, and you might as well do it from that jurisdiction that that makes it easier. And actually, the UK proposals are to be quite open to foreign issued stablecoins, which again almost sort of begs the question: why wouldn't you just go and issue somewhere else if it can be used just as easily locally? But it's a harder regime if you want to issue locally.
Yeah, no, it's a very fair point. And I see we have some questions up on the top, so I'll give the panelists a chance to read those. But while we do, maybe Diego, I'll come back to you, because you mentioned this at the beginning in the context of the EU. What are some of the kind of legal specific challenges that you see when it comes to multi-currency?
Yeah, I mean, I think it's multi-issuance, right? So I think there are two fundamental camps of problems. The first one is the commercials, right? By having different rules in different jurisdictions, it's just much harder to be able to comply. So you need either open frameworks that allow, a little bit what Tom was saying. If the UK allows a foreign stablecoin, regardless of the rules, that is okay, but it means that nobody will want to issue here because the rules are much harder here. So there's a commercial disincentive or incentive to issue in a particular jurisdiction. That's one thing. From a legal perspective, I think the trouble is that the user may actually be holding an asset for which the promised rights are slightly different and the credit exposure is slightly different, right? So if you've got, imagine, I'm picking on one of the jurisdictions. Let's imagine that the BVI has a really low bar to issuance and the UK has a really high bar to issuance, and you are a user that's sort of acquiring this. You may potentially be holding a BVI issued coin, and so when the music stops, you're going to try to enforce your rights against that, and there are no assets available. But your peer, your neighbor who was lucky enough to buy the UK issued coin does have those rights, and that you can trace back, right? So you know who's issued what. And ultimately, when the insolvency practitioners are there, they're protecting the estate. So they're going to be really careful in not saying, well, it's not the same coin here.
Yeah, no, it's fundamentally very challenging, and I agree. I think that as we continue to see regulatory frameworks evolve, to my mind, that's going to be one of the next challenges, is how then we look at the kind of bilateral and multilateral agreements, and if you are kind of operating across these different jurisdictions, how you grapple with those challenges. But I want to make sure we get to the audience questions as well, but I want to ask kind of maybe one final question as we look to the future before we go to audience Q&A. And I'm going to ask it to all of you, and you can pick a jurisdiction or think about it globally, which is, do regulators fundamentally want stablecoins to scale? And we've alluded to this a little bit in this whole discussion. Obviously, the frameworks are evolving, the regulation is coming, but do they want them to scale as money or a money-like instrument, if you prefer? Varun.
Great question. I think regulators much prefer the banking system to stablecoins because of credit creation. And that's the starting point. If we shift everything out of banks into stablecoins, bad for credit. And so with that in mind, they want to see limited adoption of stablecoins. It has bubbled up, ground up, so they can't fight the tide. And they're trying to put real hard fences around what it can do. But I think it will continue to challenge them. And this is a new form of money, back to the stuff we've seen back in the past. And it is challenging where they get to. But that's their thing that is holding them back from saying, actually, this is really valuable and we understand it. They just don't want everything to switch into stablecoins. And I get that. Credit creation shouldn't be done anywhere outside of a bank. But stablecoins provide payments, and that's really valuable in today's market. And it's a different technology, and it's really powerful in its own right.
Tom?
Yeah, I think we're seeing them coming around to it, at least in the UK. There's been a lot of hostility. It's been really hard to get anywhere. But I think I wonder if they were sort of hoping it would just go away, crypto more generally. And that clearly has not happened. It's gone the other way, and I think they're sort of coming around to it. And there's a lot more positivity now, speaking to the regulators, a lot more openness than there was a year ago, and obviously 2-3 years ago, even more so. And one other point I would just make is that, to be fair, especially to some of the regulators who seem most hostile, like for example the Bank of England, I think they struggle slightly with things like monetary sovereignty. So they have responsibility for the monetary system, and if people start using a sort of global foreign issued token in a global way, they just don't have the same kind of tools over that they do at the moment, where you need to have, your money basically is through a whole chain of entities that they control. So it's, or that they regulate. So it's, banks or e-money firms who participate in payment systems through which they settle payments at RTGS, which is run by the Bank of England. So that whole kind of ecosystem is something that they manage. And if it just goes elsewhere, then how do they manage their how do they achieve their objectives of monetary stability, for example?
So we're getting there, but not quite there yet. Diego?
I would echo Varun. I think they prefer the banking system, but they like the growth that the stablecoins bring, and that I think that's the message. And I think so that puts them in this really very, very difficult position where they're navigating, on the one hand, the management of risks that they know and love and have been worried about for a long time, against the potential growth opportunities. And so they don't want to be seen as, killing one or the other, but possibly they are doing it as a result of just not being decisive enough.
Michelle?
So one of the challenges, and Tom set it up well, so thank you, it's globalization. So you were talking about something that can be issued anywhere, from any time, by anyone, and you have regional regulators. So there's cohesion and harmony behind the scenes and sort of in front of the scenes, Mika, CARF, and a few other things. But you then go to geographies who are regulating their geography, entities regulating their entities. But if people don't like what England is saying, they'll just go somewhere else and issue a GBP. So the globalization and harmonization there is one of the challenges that I think regulators continue to face. We work a lot with US Treasury and a few other. They're trying to figure out this exact issue. Like, they want to maintain the dollar's strength, but then someone can go issue it elsewhere. So it's until that ability for global harmonization, these challenges and growing pains are still going to continue, but the velocity, scale, transparency, and potential, all the regulators seem to, once they start to understand it, it becomes an aha moment. But they're way more comfortable with banks because it's the known entity. It's been hundreds of years. But if you go back historically, over those hundreds of years, a lot of things have happened that haven't been great. So it's learning.
Yeah, I mean, I agree. I think all great perspectives, and I think since we started a little late, we can keep going with our Q&A. I'm going to keep going until I get the 5 minutes. I'm going to pick some of these ones from here first, but we will come to you guys in the audience, or you can catch us in the coffee break. I think this first one, we've kind of already answered that. Are regulators making the mistake of viewing these like banks rather than money market funds? I mean, I think you guys have covered that. They don't view them as banks. They're kind of worried about the risk to the banking system. Do you guys agree?
Yeah, they're using a lot of similar tools, regulatory tools that they use for banks. That there's questions that we've touched on whether or not that's appropriate, but yeah, I think they get.
But I think the question is slightly different. No, it's basically, I think it's asking, is the analogy here, rather than the analogy being a bank, is the analogy actually a fund, an instrument where it, and I think there is a lot of merit in this question because they look, functionally, and we had this discussion yesterday. Actually, they look functionally very similar. The one difference, I suppose, if you just look at it from an investment perspective, is one pays yield or is allowed to pay yield, and the other one isn't. And so, from that perspective, I have a lot of sympathy with that perspective. Now, if that's the case, then we would have to regulate the issuer as a sort of fund manager, right? Which also makes sense. And then I would point out that the fund manager is much lighter regulated than any bank.
Exactly.
Yeah.
but is not allowed to market its securities as openly as banks. So if you want retail, I think you need to go into the banking model. If you want sophisticated and wholesale, you need to go into the funds model.
But it's none of those. It's because it's payments, right? And the difference here is that money market funds aren't offered to the retail customer. In the stablecoins, you are trying to give this to a retail customer to pay with. And the problem is what happens when something breaks. And so they have to think about this in a payment context, that this has to be there to serve the public, and it has a much more material impact and the immediacy of something going wrong. So it is between those, and I think they understand it's between those. But there is different frameworks.
When you get into it and you look at the exact legal structures and what rights people have, you do realise that it is something new. So, people often try and say, oh, it's just a deposit or it's just a debt product or whatever, but it is, the way it works, actually, if you look at sort of the contracts and what rights you have, if you hold USDC, are slightly different to anything that we have at the moment.
Yeah. All right. Well, good question. It sparked debate, certainly. All right. Any of these other ones you guys want to pick, or should we go for one audience question? I've been given the 5-minute Q&A.
Can I take that issuer question?
Yeah.
So the issue one, it says if Tether loses their keys, or if someone gets hold of Tether's keys. So issuer risk. Absolutely right. There is issuer risk with any issuer of money. And the parallel today is when you put money in a bank account, they are the issuer of your money. If they get something wrong, either operationally or in terms of their financial risk, then you are beholden to that risk. So when Credit Suisse went down, anyone who had an account at Credit Suisse was risking those funds. And in this context, you're talking about an operational risk. So you're absolutely right. If Tether lost access to its keys, then that would be a risk. That's the kind of thing that is our bread and butter, and why they need to have the best quality key management. But the fundamental point here is that you're concentrating a lot of risks. So would you want one issuer in the world issuing all types of this money? Probably not, because that's probably a concentration risk you don't want. So maybe that speaks to your point about having many issuers, many different currencies to spread some of that risk around. But it really comes down to trust and credibility. And that those issuers out there, the ones that will survive, better have the best key management, operational procedures, as well as brand and credit risk and risk management to manage that.
All right, I think we have time for one more question, and that gentleman there has had his hand up very patiently throughout this whole thing. So we'll go for his and then catch the rest of us in the coffee break.
I got lucky. I have a fairly specific question. I think the distinction between liquidity risk and backing risk is interesting, and the obvious solution to that would be give stablecoin issuers access to the repo window, because what you're really looking at is a massive liquidation of treasuries, government debt. Backing risk is the same with a market distortion. My question is, does that need to change? Because Tether, or Circle rather, not Tether, has their treasury at BNY Mellon, which is a primary dealer, which has access to the Fed repo facility. Does anything need to change to solve that tail risk of massive redemptions, or has the fact that you've got custody at the banking institutions that already have access to the repo window solved that problem today?
Excellent question.
So I think what we saw when Silicon Valley Bank went down, and you saw Circle redemptions and Tether redemptions and over a prolonged period, I don't think it's sufficient for the custodian to have access to those facilities. I think the issuer needs to be able to liquidate. In that case, put Circle aside, Tether had to manage, I think, 25% outflows over the course of a month. And because they had maturity matched very neatly, they were able to sell and liquidate fast enough. I don't think it's enough for the custodian to have access to those facilities. But the issuer can have access to repo in this world. And we're seeing that more and more. You can have repo on all these assets. And so there is a liquid market, a secondary market out there that is enabling that turnover of debt.
So just to look at the SVB example, it was not the treasuries that were the problem directly. It was the cash, the bank deposits that they had stored there that created the problem.
For Circle, you're absolutely right. But the Tether redemptions, they had to manage that. And my point is that they can manage that without access to the Fed. They can manage it in secondary markets, provided they have the liquidity profile right.
So I think this is, well, first of all, obviously a very fascinating conversation. I can see other people want to jump in. Unfortunately, we are going to have to do it in the coffee break. There is a very long day of wonderful panels ahead of us, and I do not want to cut their time short. So thank you so much for all the great questions, and thank you to the fantastic panel.
Good question.
Sorry.